Hey, welcome back everyone to another episode of the Midtown View. I'm your host, Jim Wenk, and with me today, I got another very, very special guest. Please welcome Matt Schreck, Head of Research for the Tri-State New York area for Savills. Welcome, Matt.
Thank you, Jim.
Thank you for coming on today.
I'm happy to be here.
Yeah.
It's the 2nd of April, so the quarter just ended, and there's no better time to talk about the Midtown market and where we're at.
Love it. So I was trying to get you yesterday for the April Fool's joke, but looks like today we got to talk about some real data.
Yeah. I mean, I'd be lying if I said the reports were always, as equally interesting, but to be honest, sometimes what's going on out there is more interesting than other times, and fortunately, I think for us, things are changing. A lot is happening out there in the market, in the office market. So there is a lot to talk about and dig into, which I'm really excited about.
Awesome. So just for our viewers, the context for today, it's really, this is around office leasing, primarily in Manhattan. And we track lots of different statistics and data sets, quarter over quarter, year over year, changes in vacancy and pricing and absorption, so there's a lot to unpack. But Matt, I guess maybe just to start, are there any overarching themes that you've seen transpire this quarter versus last, the year-end 2024, or from a prior year? Any big themes that you're seeing from your perspective?
Yeah, well, leasing activity in Manhattan for Q1 was really strong. We tracked 12.2 million square feet of leasing volume in the first quarter. And typically, not always, but typically we see a strong flurry of activity to close out the year because companies want to get deals done, get them on the books. So our Q4s typically have a heightened level of activity. And then you see a little bit of a lull into Q1 before things pick back up. It doesn't always go that way, but that's usually the flow. But this time around, we saw, I think it was 9.5 million square feet, 9 and change in Q4 into an even stronger Q1. So this in Q1, the 12.2 million square feet I mentioned was the most leasing activity in a quarter since Q4 2019, right before the pandemic. And it was, to that other point, the strongest Q1 in over a decade, since 2014. Amazing. So it just really gives an idea of how much activity has come back. And we say this all the time, that the Manhattan office market is not a monolith. It varies significantly by submarket, by what part of town you're in, by what type of asset class we're talking about. So there's a lot of nuance beneath those sort of headline figures. But the one big message is that, activity is back. Manhattan, from an office leasing standpoint, is really in a class of its own compared to other major US markets.
That's huge. So we have, and I mean, we can get into this more, but I would imagine a lot has to do with the composition of the industries. So, for New York, and we know Midtown has performed extremely well for a couple years now, really. But the composition of the tenant base is finance, it's legal, it's business services. But I think, would love to hear your view on this. What I've seen just, from our client base and what we see out in the market, there's definitely been a resurgence in the technology sector over the last 6 or 12 months. So we're definitely starting to see a flurry of activity with companies that are both New York based and coming in from the West Coast to open up East Coast hubs. So any other thoughts or comments just about, or is it kind of more of the same, as far as what's driving this amount of leasing activity?
The sands are shifting a little bit, as you said, and I fully agree that New York's activity has been stronger, faster than many other markets because of the composition of industries, and it really was those financial services firms, especially in the private equity hedge fund space, the big law firms, sort of business services type firms that have been driving most of the activity the past 2+ years, call it, and they are still very active, but we are starting to see that tech media activity pick back up. It's not, all the way back to where it was, pre-pandemic, but it is definitely moving in that direction. We saw some big leases signed. Universal Music Group did a big deal at Penn 2. Horizon Media renewed a big lease in Midtown South. There were a lot of other small to mid-size leases in Midtown South, which tends to be, the tech-centric location, even though there's activity in Midtown too. But yeah, I think the level of activity we're seeing is just continued interest from the traditional office users, the finance, the law firms that want to secure the best space, which we can get into this more later, but that's getting more difficult to do and more competitive.
Yes.
But tech is definitely picking back up. And then, additionally, just from the conversations that I've had with our other researchers in other markets, San Francisco had a pretty interesting quarter too. I believe it was around 3.3 million square feet of space, office space leased in San Francisco in Q1, which is a big number for that market. Early days as far as recovery goes. The office availability rate in that market is still, I think, well above 30%. So a long way left to fall and find equilibrium in the future, hopefully.
Yep.
But that's a step in the right direction. We saw a lot of big renewals out there by Google, AI companies continuing to look for space. And you just figure that if activity is picking up there, we're seeing movement on that front here. Some of that is going to go west to east, and we're going to see a continuation of that trend.
Yeah, that's huge. I mean, we know before the pandemic, besides our traditional users like finance and legal, business services, huge driver of our market was tech.
Yep.
And then also a lot of the co-working, you had the whole WeWork effect.
That's
and
true too.
the Regis, IWGs. What's interesting, it seems like just because we know some of these startup businesses or the AI companies from the West Coast, they'll start in WeWorks or Industrious, and then now they're coming out, they're absorbing a sublease, they're taking their first kind of real, office commitment. So that's one of the observations that me and my team have seen, but I think many others have seen as well. But I think, we always think about what's going to continue to drive the market. And I think I would love to hear, for our viewers that, like we always say, not always, but that this market has been bifurcated. You kind of have Park Avenue, which has, I think, record low vacancy. Absolutely. You could speak to that. You have the Midtown core, and then you have other pockets within Manhattan that are underperforming. Yeah. So maybe could you speak a little to that, kind of narrative as well?
Yeah, there's definitely been a lot of ink spilled and conversations had around how the market has been bifurcated and just the whole flight to quality trend, which I know has been talked to death, but it doesn't make it any less true. It's really been a tale of two markets, for lack of a better phrasing. But the high-end market continues to perform really well. It seems from looking at the data, gauging the sentiment of the market, that the high-end office market is shifting more from a tenant favorable market towards a more landlord favorable market, just because the available space options are drying up. There's more competition to secure those best-in-class spaces. And then on the completely opposite side of the coin, the other side of the coin, if you look at commodity space in buildings that maybe are not as well located, it's a long walk from a transit hub. They're kind of in a desert as far as nearest subway stations, especially in this era where more people are going back to the office. But as a company, you still want to incentivize and entice your people to go to the office. It's easier to incentivize people than to hardline enforce mandates, right? Yes. So you want nice, convenient spaces for that reason. So I think a lot of those less well-located, commodity-type older buildings are going to continue to struggle. A lot of them are saddled with some debt issues that are going to come due at some point. I don't want to give the idea that it's all sunshine and roses out there, because there are definitely still pockets of the market that are significantly challenged. But yeah, when you look at the high-end market, the trophy buildings, the Class A plus, so to speak, you know, like you said, along Park Avenue, where the availability rate is, I think, less than 6% or right around 6%. You know, Hudson Yards, it's less than 10% now that those new buildings have all been leased up. It's bifurcated.
Yeah, I mean, we could look literally right here, and you know, we saw a deal get done here next at 375 Park. I think the starting rent was $250 a foot.
Yep.
There was, by a sovereign investment firm, and we know the Seagram's building has virtually no space available. Our building here at 399 Park has no space available. And we can go building by building down Park Avenue.
Yeah, I mean, 425, which is what, 1 or 2 blocks up, had a deal close. I think it was just in Q1, $220 a square foot, and I think there's maybe 1 sublease floor available in that building. So countless examples along this corridor where we're sitting. And just anecdotally, I mean, I'm sure you feel it too, just relative to a few years ago. I'm always looking at the data and looking for these sort of empirical evidence, but even just coming into work and walking the streets every day, the level of activity in this specific part of town, it's night and day compared to you know, when I started at Savills here in 2021.
Yes, it almost feels busier than pre-pandemic. I mean, it really does. The restaurants, the foot traffic, you know, the occupancy in these offices, because of the composition of these tenants in these buildings, a lot of them are financial services, and a lot of them, overwhelming majority, are in the office 4 to 5 days a week. So it is busy here on a Friday. Again, it's a tale of two cities in that regard. And I think there's other pockets of town where it's busy Tuesday, Wednesday, Thursday, but maybe not so much on Friday and Monday. But the bottom line is the overarching theme is significant recovery. We had a very significant amount of space leased for this quarter relative to just at the pandemic or before the pandemic. And you know, still many would say we're in uncertain times. I mean, business climate, you know, geopolitics, you can look at other factors that would cause trepidation from people making commitments, but people are making commitments.
People are making commitments, and that's definitely an interesting angle and to monitor, and something that we, from a research standpoint, are always monitoring. That's the big thing. When you look at the office market, especially when you look at Manhattan's office market, you know, a few quarters, a few years out, and try to think about where we're going to be, I think the biggest risk that we could potentially foresee is the economy. You know, don't want to wade too far into the political waters, but at the end of the day, there has been a lot of uncertainty created around the sort of whiplash tariff policies. And you know, today, like we said, is April 2nd. Supposedly there's going to be big announcements today from a tariffs standpoint. So that definitely creates uncertainty. I think it creates a lot more uncertainty in the retail and the industrial spaces, because those sectors are more immediately exposed to global trade risks. They feel it right away, whereas the office sector feels those kind of effects further downstream in a more general sense relating to the health of the overall economy. So, you know, I'm certainly not sitting here saying, oh, we're at risk of a recession. I think that's a minority percent, you know, risk at this point, but it's certainly something to be mindful of, you know. But otherwise, barring that, it seems like, you know, business confidence is high. Executives are willing to commit to office space. The perception around work from home and hybrid work has certainly shifted, where, you know, certain firms are approaching it in different ways, but I think the consensus understanding has become that the office is a part of the way we work.
Yes.
What specific part and how much of a part, is going to vary on a case-by-case basis, but it's certainly here to stay. And as long as the economy is growing, then we should continue to see demand for space.
Amazing. I mean, I think, again, I'm going to use Park Avenue just because we're here, but we have a couple blocks down here at 350 Park and the building right behind it, 40 East 52nd. They're slated to come down and be raised over the next 12 to 18 months to make way for Citadel, anchoring a new, I think it's 1.4 million square foot building, and that would be slated for completion, I think, in 2032. But we've already heard that Citadel originally was going to start at 850,000 feet. Now they're committed up to over 1 million square feet. So they're one of the big behemoths that took a 500,000 square feet down the street here on Fifth Avenue. To hold them over until that's constructed. But you were also, JP Morgan purchased 250 Park Avenue, and they're obviously completing their new headquarters at 270. And there's not much development pipeline in this immediate area. You have the Boston property site on at 343 Madison, so they're aggressively looking for an anchor tenant to get that out of the ground, but they're ready to go with that site. I think it's entitled and approved. And if we just look around, there is really very small pockets, with the exception, there's a building right behind you, which is the old Bank Santander building that was redeveloped on the inside and really set up very nicely for boutique, smaller companies. But other than that, I mean, most of these buildings are really full.
Yeah, it's crazy to think about how the supply side is more of the risk factor now, compared to a few years ago. But things can change quickly, and just because of what we talked about with how much demand for space there continues to be in this high-end market, especially for new construction, there's certainly not enough of it at the moment. So that's a near to medium term concern. I mean, in the next year or so, we've got about 200,000 square feet of new space coming at 525th, which I think is topped out. Yes. But that's a mixed-use building. A lot of that is going to be residential, but some office space. And then there's the Rolex building over on Fifth Avenue, some space, but not a lot. I mean, I think that totals up to something like 400,000 square feet, which is really a drop in the bucket. I mean, Terminal Warehouse, they're touring. I don't know if they have certificates of occupancy.
Not quite yet, but they're getting close.
But that's close. But that's Midtown South, that's West Chelsea. It's a completely different part of the market. Outside of those other two buildings I just mentioned, there's not really anything else coming until maybe 2028 if things move fast. So, by that point, maybe we get 70 Hudson, maybe we get 2 World Trade downtown, a year or two out from there. Like you said, 350 Park is an exciting one. That's not going to be until the 2030s. And with the rate that Citadel is going, we're expecting there to be other space available for lease when that building's completed. But who knows at this point?
They may need it.
They may need it. I don't know. So there's definitely a lack of new construction in the pipeline. And part of that is just because we essentially missed a development cycle due to the effects of the pandemic and high interest rates, high construction costs all played a factor. And now we're sort of feeling it. So, tenant representatives and brokers like yourself are going to have to flex the creativity a lot more in the coming years, I think, just because it's not going to be as simple as, calling up a bunch of landlords and agents and saying, hey, we'd like to tour your space, and comparing them and signing a lease. It's going to have to be, uncovering shadow space from users who are technically in a space and have the lease, but maybe they don't want it that bad. They're willing to give it up, and you've got to piece together these little, these blocks for clients. It's going to be a lot trickier because of this lack of new supply.
Well, I'm happy you say that because, that's one of that in a really tight market, that's what we're needed for, is to put the puzzle pieces together, get creative, come up with ideas to create opportunities for clients because, running a CoStar report is not going to be the way you solve the problem. And, that works in many other places, but when it's sub 6% vacancy, in some buildings there's no vacancy, you're calling people and trying to unlock, opportunities. So I'm happy you said that because it's the truth. Well, look, we could talk about this, all day, all night because there's so much happening, and maybe, we're gonna have you on another few months. We'll see how the second quarter wraps up, but it's I think we're seeing these trends, these overarching trends continue. And as kind of mentioned before the show, we ask our guests to provide some predictions. We got this, we got our little crystal ball here. So we'd love to hear what you think will continue or not continue over the next few months. And when we have you back in July, right after the break, maybe what you see transpire.
Yeah, I think probably a continuation of a lot of the trends we've been talking about. If I really gaze into the crystal ball here, I feel like one thing we track from a research standpoint that I don't think we've touched on yet is concession packages. Yeah. So how much tenant improvement allowance, how much free rent are tenants getting when they sign these new leases? So we look at that monthly actually, for new deals done in Class A buildings, long-term, 10 plus years, 10,000 plus square feet. Try to get a sense of what's the average, what are people getting when they sign new deals. Of course, post-pandemic, 20 through 22, strong growth on that front because, it was a tenant's market. Building owners needed to do whatever they could to convince, or incentivize firms to sign leases. But in the last 12 months or so, we've really seen the levels of TI and free rent flatten out. They're down year over year, just modestly. They're not falling off a cliff or anything like that, but everything has leveled off. We're seeing, again, some really slight growth in Class A asking rents and, taking rents, rents that clients are starting out at, or tenants are starting out at on completed deals, have taken off in certain parts of the market, like in the Plaza and in Hudson Yards. So I suppose putting all that together, my prediction would be that we are actually going to see net effective rent growth in the high-end market over the course of the rest of this year. Certainly not going to be the case in the Class B, C, in the commodity market, but in the high-end market, we're finally going to see growth in NERs, which is kind of incredible.
That is, because that's, we always know that like in a lot of these buildings, the face rents have been trickling up, but also the concessions were always up as well. So the landlord cost to get the revenue was always somewhat paralleled. Now we see the concessions, the incentives to flatten out with the growth of the face rents, and then the net effective rents are going to be enhanced, increasing going forward. Exactly. So, Matt, that's awesome. Tremendous insight. Really appreciate your outlook and into what's happening behind the curtain. So, look forward to having you back, right after the July 4th break. But it's interesting. We got such a dynamic market going on, and you're right on the forefront, seeing it all happen in the numbers. So really appreciate you coming on.
I really appreciate you having me on. It's been great. Love talking about this stuff, and hope to do it again.
Awesome. Thank you again.
Thanks, Jim.
Thanks, everyone. That's another episode of the Midtown View. We look forward to having Matt back in a few months as we close out quarter two. Until next time, Be well. Thank you.